Yes, I was able to raise my credit score by 97 points in just 30 days. Welcome to another video where I tackle things that could help you achieve your goals in real estate investment. This is Gabby, managing broker and property manager at Nex-Gen Real Estate in Northeast Illinois. And in today's video, I want to share with you how understanding the credit scoring system made me more purposeful and scored me great deals on financing. I will also share with you some of my hacks that made it possible. Your credit score is one of the most important measures of your financial health. It tells lenders at a glance how responsibly you use credit. The better your score, the easier you will find it to be approved for new loans or lines of credit. Take note that there are many different scoring systems and algorithms when calculating a credit score. I'm sure you have heard of credit bureaus like Experian, TransUnion, and Equifax. All three of those have multiple different scoring models within themselves, and that is why they vary. They also have different scales. It can get overwhelming and exhausting, but overall, the goal for these companies is to collect data and grade you on the ability to pay off your debt. The following are different areas they are grading: utilization ratio, on-time payment history, derogatory marks, age of credit history, new inquiries, and total accounts. I want you to know that credit scores changed based on your creditor's reporting, so it will differ sometimes even as often as from day to day. A great analogy is thinking of a credit score like your weight. In the mornings, it will be different than in the afternoons, but that doesn't necessarily mean you have more fat. And the scoring system is the difference between reading your weight in kilos versus pounds. At the end of the day, it's the same thing. Now let's get into the details. Let's tackle utilization ratio first. The bank wants to see that you are not over leveraging or taking more debt than you can afford, and that you do not max out your credit cards and lines of credit. To calculate the ratio, you take the credit use and divide it over the total of all credit card limits. For example, if you have 3 credit cards and the balances are as follows: $100, $300, and $400. With a credit line of $3,000, $1,500, and $2,000. Your total utilized amount is $800 out of $6,500 available, which is right under 23%. Now, the bank also wants to see you use your credit, since that's how they're making the money. So the sweet spot is for you to utilize at least 1% on a monthly basis. Anything over that will proportionally affect your credit score, and if you are applying for newer credit, you definitely do not want to be using more than 49% of your current available credit. Now remember, this does not apply to fixed loans. I have some hacks for this. Hack number 1. Credit score for each account is typically reported to the bureau once a month, which is a couple of days after your monthly payment due date. Always make at least a minimum payment on the due date, but definitely have the lowest balance possible on the day that the balance is recorded. Sometimes moving your telephone bill to be scheduled after your reporting day can make a huge difference, especially when you are starting out with the credit limits in the hundreds. You can check your banking app or set up Credit Karma to track those dates. Remember that the utilization ratio does not count fixed payments such as student loans, car payments, or mortgage. Hack number 2. This one applies especially when you are starting off. Your credit limits might be low, and it will be a bit tricky to keep your utilization low. I encourage you to keep your score healthy and ask for credit increase religiously every 6 months. This will not hurt your credit, and you will have better chances of getting your credit increased rather than waiting for the bank to contact you, which rarely happens. On-time payments. Always make at least the minimum amount payment. This can be easily done by linking your checking account and setting up autopay. I get life happens and emergencies come up, but make sure you do not spend more than you can afford and always pay your card in full. Here's another hack for you. If you end up missing a loan or a fixed monthly payment, pay it off immediately. The creditors will typically give you 30 days before they report the payment late. This does add additional late fees and penalties that are just not worth it. Also, take a note of this. Let's say you are 2 months behind on your car loan. Each missing month is counted separately. So if you miss your January 1st car payment and you do not pay it until February 15th, you have a 30-day missed payment reported to the Bureau. And if you do not pay the next month's payment on time, it will add another missed payment. Always pay off the entire amount owed as soon as possible. The late payments are calculated based on a percentage of late payments made throughout your entire credit history. You want to be as close to 100% on-time payments as possible. If you do end up having some late payments, the most recent late payments will affect your credit score the most. What it means is that your late payment 3 years ago will not have the same weight as a late payment from last month. Let's move on to derogatory marks. Those are any collection, tax liens, bankruptcies, or judgments against you, and they stay on your credit report for 8 years since the last recording. What it means is that if you have a debt in the collection and you pay it off after 2 years, it will stay on your report for 8 more years. The derogatory marks affect the credit score the most first year. Each month after that, they have a smaller and smaller impact on your overall credit. Comment below if you are interested in a tutorial on how to legally take off collection items or errors off your credit report. Next on the list is the age of credit history. One golden tip is to never close your first account. The way the bank calculates your age of the credit history is by taking the length of all your credit accounts and calculating the average of all the time combined. For example, let's say you have 2 credit cards. Your first one is 3 years old and your newest one you just got. It means that the average credit history for you is 1.5 years. Big difference, right? The greater the average age of credit, the better for you. This is a lifelong process. Before we move on to the last item, subscribe and turn on your notification bells for future videos about anything real estate. Now let's talk about excessive inquiries for credit by third-party creditors and total number of accounts. These are factors that could negatively impact your credit score. Ideally, you want to limit the number of new inquiries to less than 2 new per year. That includes any type of credit check, such as when you apply for a new apartment to lease or a job screening. Note, when you're applying for a mortgage, you have a 14 to 15 day window to shop for the best rates, and it is collectively counted as one inquiry according to Equifax. Similar exception applies for car loans, even though you have much less than 14 days. When banks sees that you have a lot of requests for loans, it appears that you are credit hungry, which in their eyes could mean that you are in financial trouble, and they will be very careful when reviewing your application. As to the total amount of accounts, you want to have as many accounts as possible, both closed and open. Biggest hack of all is having someone financially responsible add you to their oldest credit card as an authorized user. As an authorized user, the institution will report you to the Bureau just like the primary user. Once again, if they're responsible and are following all the credit rules that we have talked about, it will boost your credit score immediately. And the best thing, you don't have to use their credit. Now, if they end up not being as responsible as you thought, it will negatively affect your credit. So please be super careful. And for those that are not as lucky and are either starting from zero or have a bad credit history and no one to rely on, there is an option for you, and that is a secured credit card. What happens is that you deposit, let's say $1,000 to the bank in order for your monthly credit limit to be $1,000. It is not like a debit card, and it is not prepaid. Therefore, each month you still need to make payments on what you have used on that card. After a little over a year of good management, you can ask the bank to reconsider and give you the initial deposit back. I know the entire process might be a little overwhelming, but very worthy. This could be a difference between a $900 monthly payment and a $400 one for the same car. Do you have any questions about credit score systems? Thank you so much for watching. See you in the next video, and as always, where's your future?